Now, the only other thing that I can think of that's really cash budgets, they're not too difficult. But what if this had happened? I'm gonna just make,
Sure.
I'm not gonna change, we're just gonna ignore everything but the borrowing section, the
okay.
financing section for a second. So just ignore all the other numbers, I'm not gonna make them work anymore.
What if?
Okay, what if we also had to borrow $20,000 here? How would we calculate
Okay.
the interest here? So let's say we're gonna repay everything all at once, so we just we're gonna repay them, so it's gonna be 149.
So we're not following the instructions where it's, I guess it could be paid at any time. But.
We couldn't pay it back, we needed to borrow some more money here. How do we calculate the interest that we have to repay on these? Ignoring everything else.
So you're asking by quarter, like, how would that affect our interest rate as far as?
Yeah, so how would we calculate the interest payment that we'd have?
Well, the first one occurred at the beginning of the first quarter, also in the second, and now into the third, ending in the third. Would be followed there, so it'd be 6% of, because assuming the same interest rate.
Right, we're
That's
gonna
6%
do
of.
2%, right?
Right. Per
So-
quarter.
Per quarter, yeah, so are you saying this, so you're saying take this number times 6%?
Correct.
Okay. I'm gonna show you a little bit differently because we've taken these loans out at different times, that's why this is tricky. So we took out this one at the beginning of the first, so we'll have to take our 129,000 and times it by our, oops, not 20%, that would be crazy.
It's possible.
Okay, and then how many quarters have we had this loan for? We got it at the beginning of the first, we had it for the second, we're paying it back in the third. Then we have to add to that whatever this equals, our $20,000. How long have we had this one for? Caught in the beginning second?
That is tricky.
And then whatever that sums out to be is our total interest, right?
So watch out for them and make sure that right in here.
That's the only thing that I can think of that's really tricky about
Because
this.
that's, yeah, I mean, that makes sense to, I mean, of course, I remember Brother Steve talking about that explicitly, like, be careful where your interest rates lie, because you have to take into account that there's different quarters of which they occur.
Yep. Oh,
And I believe that actually happens in this example here.
yeah, it could. Yeah, so, but they repaid at the very end of the quarter. Sometimes you'll have to watch and see when the repayments happen, because they may say they just repay it all at the end of the fourth quarter.
Right.
So you'll have to watch. Now what if,
Yeah, it says it here. Interest on 130,000 borrowed at the beginning of the first, and then 12 months, and then interest at this time, using the PRT formula.
right,
Same idea.
okay, let me do this. What if this, they told you these disbursements included, again, we're ignoring everything else, $1,000 depreciation. How would that change this problem? What would we do?
Well, depreciation happens regardless, so you reduce it $1,000. Well, is this for every quarter?
Yeah, every quarter there's $1,000 of depreciation in your disbursements.
So you reduce it $1,000 each time.
Yeah, so this one would now be 523.
Is that because it's a fixed cost?
No, nothing to do with fixed relevant costs.
Okay.
The reason is, this is, what kind of budget is this?
Cash.
Cash. Is depreciation a cash expense?
No.
No. We already paid the cash before, right?
Right.
We took care of that when we bought the equipment. We paid all of our cash, and part of our cash budget would include that in the disbursements. After that, depreciation just to allocate the cost over time. So there's no cash in depreciation.